Newmont Corporation just absolutely crushed consensus for Q2 2026. Record earnings, massive cash flow, and the stock is popping.
Yeah, I mean, the headline numbers are frankly hard to wrap your head around. It was a blowout quarter.
Totally. We are talking $6.1 billion in top-line revenue, an all-time second quarter record for adjusted net income, coming in at $2.10 per share.
Right.
And they reaffirmed their full-year guidance of 5.3 million ounces of gold, which, the market clearly loved.
Oh, absolutely. And they generated a massive $2.2 billion in free cash flow just in this single 3-month window.
Which is insane. So they finished the sprint sitting on this absolute cash fortress of $9.0 billion.
It's honestly a masterclass. I mean, they are navigating the physical and literal volatility of the planet,
Yeah.
but still maintaining absolute financial discipline.
Right. And that is exactly what we're getting into today. For you, the listener joining us, today's mission in this deep dive is to really unpack the financial health and the strategic maneuvering of Newmont, the world's leading gold company.
We're pulling all this directly from their Q2 2026 earnings press release, the Q2 results presentation, and of course, the Form 10-Q.
Okay, let's unpack this, because when we move past those pristine headline numbers, the EPS and the revenue beats, and look at the actual pricing data for the quarter, we hit a massive paradox, one that just completely defies conventional wisdom.
The pricing data is where the narrative of this quarter shifts from, just a standard earnings recap into a much deeper lesson on operational leverage.
Yeah.
What stands out to you the most in those pricing tables?
It has to be the average realized gold price. I mean, I am looking at the Q1 2026 numbers, right? And Newmont was realizing $4,900 per ounce of gold.
Right, a really strong price.
But then here in Q2, that average realized price dropped down to $4,414 per ounce.
That's a huge drop.
Yeah, that is a drop of almost $500 an ounce, quarter over quarter. So I have to challenge the basic premise here.
Go for it.
If you are a company literally named for mining gold, and the price of that gold drops by nearly $500 an ounce, how on earth do you generate $2.2 billion in free cash flow? How do you hit a Q2 earnings record with that headwind?
It's a great question.
I mean, if a tech company had to drop their software subscription price by 10% overnight, their cash flow would just vaporize.
What's fascinating here is that it completely redefines how you have to analyze a modern mega miner.
Right.
Look, if Newmont only mined gold, you would be absolutely right.
Right.
A $500 drop in the realized price would have just crushed their margins. But they don't just mine gold.
Ah, okay.
When you're moving millions of tons of rock, you're extracting a really complex basket of metals. So alongside that 1.3 million ounces of gold in Q2, Newmont also produced 7 million ounces of silver.
Wow, 7 million.
Yeah, plus 17,000 tons of copper, 18,000 tons of lead, and 40,000 tons of zinc.
That is a massive amount of base metals just sort of coming along for the ride.
Exactly.
But how does that actually rescue the balance sheet from a $500 drop in gold prices? I mean, base metals are great, but gold is the main event.
It all comes down to a crucial metric in mining finance called costs applicable to sales, or CAS. And specifically, CAS calculated on a byproduct basis.
Okay, break that down for me.
Let's look at how that mechanism actually works in the real world. Mining gold costs money, obviously. You have labor, diesel, explosives, equipment maintenance.
Sure, all the heavy industrial stuff.
Right. But when you refine that ore and separate out the silver, the copper, the lead, and the zinc, you sell those secondary metals on the open market.
Okay, I follow.
So in Newmont's accounting, they take the revenue generated from selling those byproducts and they apply it as a direct credit against the cost of mining the gold.
Oh, I see. So because they had such strong production volumes in these other metals, particularly silver, which I see was a major driver at their Penasquito mine in Mexico, they are essentially using the revenue from a massive side hustle in base metals to subsidize the core gold business.
Precisely. Those secondary metals act as this structural financial buffer. They offset the direct operating costs, meaning the net cost to produce an ounce of gold drops significantly.
That's actually brilliant.
Yeah, it really is. It effectively insulates the company's cash flow, allowing them to remain highly profitable even when the gold price takes a temporary yet severe dip like we saw this quarter.
So they've engineered this brilliant financial buffer, but a financial buffer only works if the mines are actually operating, right?
Well, yes. That's the catch.
You can have all the copper and silver credits in the world, but if the heavy machinery stops moving, the math breaks down. And in Q2, the physical reality of the Earth tested that buffer to its absolute limits.
Which brings us to the most significant operational hurdle they faced this quarter. Look, the Earth is not a static spreadsheet, and geology does not care about quarterly earnings targets.
No, it really doesn't. And we see that starkly in the cost metrics. Because of those co-product credits you just explained, their direct costs applicable to sales, the CAS, stayed at a very respectable $1,043 per ounce.
Which is great.
It is. However, their gold all-in sustaining costs, their AISC, jumped a massive 58% to $1,621 per ounce for the quarter.
Yeah, that's a steep climb.
I always see these two acronyms, CAS and AISC, and honestly, they tend to just blur together for me. How exactly do byproduct credits keep one cost low but leave the other exposed to a 58% spike?
It is a vital distinction for anyone looking at these companies. CIS costs applicable to sales is strictly the direct cost of pulling the rock out of the ground and processing it, minus those byproduct credits we discussed.
Okay, the immediate operational cost.
Right. But AISC, all-in sustaining costs, is a much broader, more comprehensive metric. It takes that direct cost and adds in all the capital required to maintain the business over time.
Got it.
We are talking about sustaining capital expenditures to replace aging trucks, regional exploration to find the next ore body, and general corporate administration. AISC is the true cost of keeping the lights on and the business running flat.
And the reason that broader costs spike to $1,621 an ounce is directly tied to what happened at their Cadia mine in Australia.
Exactly. In April 2026, a significant seismic event, basically an earthquake, occurred to the Cadia operation.
Wow.
Yeah, it forced a total shutdown of the mine for safety and structural assessments.
Yeah.
They did not resume normal production levels there until mid-June.
So you were talking about losing a premier Tier 1 asset for roughly 2 months out of a 3-month quarter.
It's massive.
So to tie that back to the costs, during those 2 months, they are producing 0 ounces of gold at Cadia. But they still have to pay the workforce.
Absolutely.
They still have to run the ventilation systems. They still have to conduct massive geotechnical safety checks. So the numerator, the fixed costs, stays incredibly high, but the denominator, the ounces of gold produced to divide those costs by, shrinks to 0.
That is the exact mathematical mechanism that drove the consolidated AISC up across the entire company. You have all this sustaining capital flowing out the door at Cadia with no immediate revenue to offset it.
But here's where it gets really interesting. They lose a massive operation for 2 months, right? Yet I am looking at their full-year guidance, and they remain completely on track to hit 5.3 million ounces of gold.
Yeah, that's pretty well.
They didn't revise their target down by a single ounce. How do you lose a flagship asset for 60 days and not miss a beat on your annual forecast?
This is where we transition from financial engineering to pure operational logistics. It demonstrates why massive scale is a prerequisite for stability in the modern mining industry.
Okay.
Think of Newmont's portfolio like a global power grid. If a major power plant trips offline in one city, a well-designed grid doesn't just let the city go dark.
Right, it pulls from elsewhere.
Exactly.
Yeah.
It automatically pulls reserve capacity from generation stations in other regions to stabilize the system and prevent a blackout.
I love that analogy. So when the Cadia power plant tripped offline, which mines provided the reserve capacity?
Primarily, their Yanacocha mine in Peru and their Lihir mine in Papua New Guinea. Because Newmont operates this globally distributed portfolio, they have incredible operational redundancy. They utilize dynamic mine sequencing to cover the gap.
Okay, walk me through dynamic mine sequencing. I imagine they can't just, tell the miners to swing their pickaxes faster.
No, you can't just mine harder.
Right.
Mine sequencing is about the geometric puzzle of the open pit or the underground tunnel network. Mines operate on strict 3 to 5 year plans, extracting a mix of high-grade and low-grade ore to maintain a steady output.
Makes sense.
When Cadia went down, the engineers at Yanacocha and Lihir pivoted. They moved their massive excavators and haul fleets to access higher-grade zones of the ore body earlier than originally scheduled.
Oh, wow.
Yeah, they essentially pulled future gold production forward into the second quarter.
That is fascinating. So the global grid stabilized the blackout. They shifted the physical logistics on entirely different continents to seamlessly cover the shortfall in Australia.
Yeah.
It really highlights that as an investor, you aren't just betting on the spot price of gold, right? You are investing in the management team's ability to orchestrate that portfolio.
It is a self-insuring mechanism against geopolitical risks, weather events, or, in this case, severe geological surprises.
But surviving an earthquake and shifting some dirt around to hit quarterly numbers, that's a short-term fix. Setting up the next decade of production requires an entirely different level of foresight.
Absolutely.
We know their massive 2025 divestment program is fully complete. They spent the last year trimming the fat and selling off non-core assets. So, how is Newmont positioning itself for the future now that the portfolio is streamlined?
Well, now that the divestments are done, the focus shifts entirely to bringing their next generation of long-life assets online. Mining is an industry with a naturally depleting asset base.
Because every ounce you mine is gone forever.
Exactly. The moment you pull an ounce out of the ground, your company is worth slightly less unless you can replace it. You have to constantly invest today to ensure you have a business tomorrow.
And we are seeing those future investments start to generate real returns right now.
We are.
For instance, the Ahafo North project in Ghana. That hit commercial production back in the fourth quarter of 2025, and now in these Q2 2026 results, we see it operating as a fully mature, reportable segment, contributing to that $2.2 billion in free cash flow.
Right. It's fully online.
But the project that really jumps out of the 10Q for the long-term future is the Red Chris Block Cave project in British Columbia.
Red Chris is an absolutely critical cornerstone for their future copper and gold production. Yeah. They are transitioning it into a block cave operation.
Okay, I have to stop you there. I hear block cave mentioned in mining reports all the time, but for, the listener who doesn't have a mining engineering degree, what exactly is the mechanism of a block cave, and why is Newmont betting their future on it at Red Chris?
It is a highly complex yet incredibly efficient underground mining method. So instead of digging a massive open pit from the surface, which moves a lot of waste rock, or drilling expensive horizontal tunnels to chase narrow veins of gold, block caving uses gravity to do the heavy lifting. The engineers drill deep underneath the main ore body and create a massive artificial cavern. They essentially undercut the rock.
So they literally pull the rug out from under the mountain.
Exactly. Once that undercut is blasted, the structural integrity of the rock above it fails. The mountain slowly collapses under its own immense weight, crushing the ore into smaller, manageable chunks that funnel down into extraction points where loaders scoop it up.
That is wild.
The beauty of block caving is that once the initial infrastructure is built, the operating costs are incredibly low. Gravity breaks the rock for you.
But there's a catch, right?
Always. The hurdle is that it requires massive upfront capital and years of complex permitting before you see a single ounce of metal.
Which makes the milestone they just achieved at Red Chris so significant.
If we connect this to the bigger picture, it is not just what they achieved with Red Chris permitting, it is how they achieved it. They recently received an amended environmental assessment certificate for the project. But this wasn't just a matter of submitting forms to a government bureaucrat and waiting for a stamp of approval. It was achieved through a formalized, consent-based process with the Tahltan Nation.
That feels like a massive evolutionary shift in how these billion-dollar infrastructure projects are being handled. I mean, historically, permitting has been a very top-down transactional process.
It is a complete paradigm shift, and it represents the new reality of the resource sector. A consent-based process goes far beyond holding a few public town halls.
Right.
It means co-management. It means weaving indigenous knowledge and environmental priorities directly into the engineering design from day one. In many of these jurisdictions, indigenous groups have true veto power over development.
Which ties perfectly into the data from their newly published 2025 Annual Sustainability Report. When you read through it, you realize these environmental and social initiatives aren't just PR exercises to look good in a glossy brochure.
Not at all.
They are literally how Newmont secures its future cash flows. Look at the $1.8 billion water treatment plant they are building at Yanacocha in Peru. Why would a gold company spend almost $2 billion on a water filter?
Because if they don't, they lose the mine. Mining exposes fresh rock to oxygen and water, which can create acid mine drainage, heavy metals leaching to the local watershed.
Which is a disaster.
Exactly. In a place like Peru, where local communities rely entirely on that water for agriculture, contaminating the watershed would instantly destroy Newmont's social license to operate. The local population would blockade the roads, the government would pull their permits, and that Tier 1 asset would be stranded.
So spending $1.8 billion on water treatment is effectively paying an insurance premium to guarantee access to tens of billions of dollars worth of gold underground.
Exactly. By proving they are responsible stewards of the local ecosystem and working in genuine partnership with local nations, they mitigate sovereign risk. It makes Newmont the partner of choice for host governments globally. Because look, if you do not have a social license, Your geological data is completely worthless.
Okay, so they have the global portfolio diversity to survive a massive earthquake, and they have the social and environmental framework to actually build the mines of tomorrow. That brings us to the ultimate question for you, the listener sitting at home analyzing your portfolio.
The cash.
Exactly. What is Newmont actually doing with this massive $3.4 billion net cash position? They are throwing off a historic amount of cash. How is management allocating it?
They utilize a very rigid, prioritized capital allocation framework. It removes the emotion from the boom and bust commodity cycles.
So what's priority number one?
First priority is sustaining capital, keeping the current mines running safely and securely. Second is funding the baseline dividend. Third is development capital for those future growth projects like Red Chris. And finally, whatever excess cash is left over goes toward maintaining an optimized balance sheet and returning value to shareholders through buybacks.
Let's break down those returns because the numbers deployed since the last earnings call are pretty staggering. They have returned $1.9 billion to shareholders in just a few months.
Yeah, it's huge.
That includes a 26-cent per share quarterly dividend, putting them on track to pay out $1.1 billion annually just in dividends. But the stock buybacks are where the real aggressive structural maneuvering is happening. They executed $1.7 billion in stock buybacks recently out of a massive $6.0 billion authorization program.
This raises an important question about how retail investors should view buybacks in a cyclical commodity business.
Oh.
Because Newmont isn't just buying back stock randomly whenever they have extra cash.
Right.
They're executing what they call a ratable share repurchase program.
I have to admit, when I hear terms like ratable share repurchase, my eyes tend to sort of glaze over. To a retail investor, a buyback is a buyback. The company buys its stock, the price hopefully goes up. What makes this specific ratable mechanism so critical to understand?
It matters deeply because of how it interacts with their long-term dividend policy. Newmont has committed to that sustainable cash dividend of $1.1 billion per year. Think of that as a fixed pie of cash leaving the company every 12 months.
Okay, a fixed $1.1 billion pie.
Now, through this ratable buyback program, since February 2024, they have methodically repurchased and retired over 100 million shares. That is roughly 9% of their entire outstanding share count, completely removed from the market.
Okay. So if I am holding Newmont stock in my retirement account, the overall pie of dividend cash stays the exact same size, but there are 9% fewer people at the table asking for a slice.
That is the perfect way to visualize it.
Yeah.
By permanently shrinking the share count, your specific slice of the pie just got 9% bigger without you having to invest another dime. It creates a built-in pathway to grow the per-share dividend over time, without the company having to actually increase its total financial payout.
So what does this all mean for the long-term health of the company? It means Newmont has built a financial framework designed specifically to be indestructible through the inevitable boom and bust cycles of commodities.
Yep.
They are using the massive cash flow from the boom times, like this $2.2 billion quarter, to permanently shrink their equity base. That makes the dividend infinitely more resilient when the gold price eventually pulls back, because they are distributing the cash across a much smaller base of shares.
It is capital discipline in its purest form.
Yeah.
They are locking in the benefits of today's operational leverage to protect tomorrow's shareholders.
But as we look to tomorrow, I want to pivot before we wrap up. We've talked extensively about this incredible cash generation in the first half of the year. But when you dig into the seasonality guidance provided in the 10Q, a very specific, somewhat precarious dynamic emerges for the rest of 2026.
Yes, the back half of the year is going to test that capital discipline severely. The seasonality data paints a very clear picture of capital intensity.
Right. Despite all the operational success we just unpacked, the company's 2026 gold production is actually 51% weighted to the second half of the year.
Right.
And even more critically, they are planning to spend a disproportionate amount, 63% of their massive $1.4 billion development capital budget in the back half of the year.
Which means their cash burn is going to accelerate significantly over the next 2 quarters as they ramp up physical construction at the Konami expansion in Australia and, advance the heavy engineering feasibility studies at Red Chris.
It really sets up a fascinating tension for the next few earnings calls.
It absolutely does, and it leaves us with an essential question to ponder as we watch this company execute through the rest of the year. Well, With global inflation still driving up the cost of materials, fluctuating oil prices heavily impacting diesel fuel costs for their haul fleets, and the ever-present threat of geological surprises like we just witnessed with the Cadia earthquake, how should we view Newmont's current $9 billion cash hoard?
That's the million-dollar question.
Exactly. Is it a proactive, aggressive war chest designed to fund massive growth and acquisitions? Or is it a highly necessary defensive buffer built specifically to absorb the risk of a heavily capital-intensive, risk-exposed second half of the year?
Yeah.
It is the ultimate tightrope walk between growth and defense, and how they balance that tension will entirely define their financial performance heading into 2027.
And that dynamic tension is exactly what makes tracking this industry so fascinating. You can build the tightest, most perfectly engineered financial frameworks in the world, but at the end of the day, you still have to negotiate with the earth. Make sure you follow the show for our daily earnings coverage as we continue to track these numbers and unpack the mechanics behind the market. Until next time.